Welcome to our channel, where we provide financial education for beginners. In today's video, we're going to talk about the basics of investing. Investing is an important way to grow your money over time, but it can also be intimidating if you're new to it. In this video, we'll cover the different types of investments, how they work, and their risk-to-reward ratios and average returns, so you can make informed decisions about where to put your money. Investing, as we know it, is an important aspect of personal finance that can help you achieve your financial goals, whether it's saving for retirement, buying a home, or starting a business. Investing can also help you grow your wealth over time and protect it against inflation. So, what exactly is investing? Investing is the process of putting your money into something that has the potential to grow in value over time. This can include stocks, bonds, mutual funds, real estate, and more. Before you start investing, there are some important things to consider. First, it's important to have a solid understanding of your personal finances. This includes understanding your income, expenses, and debts. You should also have an emergency fund in place before you start investing, so you can handle any unexpected expenses that come up. When it comes to investing, there are several types of investments you can consider depending on your country or investment appetite. 1. Stocks. When you buy a stock, you're buying a piece of ownership in a company. The value of your stock will go up or down depending on how well the company performs. Stocks have a high potential for reward but also come with a high risk. On average, stocks have returned around 10% per year over the long term, but the market can be volatile. 2. Bonds. When you buy a bond, you're essentially loaning money to a company or government. In exchange, they promise to pay you back with interest. Bonds are generally less risky than stocks but also offer lower returns. The average return for bonds is around 5% per year. 3. Real estate. When you invest in real estate, you're buying a property with the intention of renting it out or selling it for a profit. Real estate has the potential for high returns but also comes with a high risk. The average return for real estate is around 7% per year. 4. Mutual funds. A mutual fund is a collection of stocks, bonds, and other investments that are managed by a professional fund manager. This is a great option if you want to invest in a variety of assets without having to choose individual stocks or bonds. Mutual funds have a moderate risk-to-reward ratio, and average returns can vary depending on the fund. 5. Exchange-traded funds, ETFs. Like mutual funds, ETFs are collections of investments that are managed by a professional. However, ETFs are traded on an exchange like stocks, which means they can be bought and sold throughout the day. ETFs have a similar risk-to-reward ratio as mutual funds, and average returns can also vary. One of the most important things to remember when it comes to investing is that it's important to have a diversified portfolio. This means investing in a variety of different types of assets, so you're not relying too heavily on any one investment. When it comes to building your investment portfolio, there are a few different approaches you can take. Some people prefer to invest in individual stocks and bonds, while others prefer to invest in mutual funds or exchange-traded funds, ETFs. It's also important to consider your investment timeline and risk tolerance. If you have a long-term investment timeline and a high tolerance for risk, you may want to consider investing in more aggressive stocks or mutual funds. If you have a shorter timeline or a lower tolerance for risk, you may want to focus on more conservative investments, such as bonds or index funds. Another important factor to consider when it comes to investing is fees. Make sure you understand the fees associated with any investments you're considering, including management fees, transaction fees, and other costs. Ultimately, it's important to remember that investment is a long-term game. By understanding the different types of investments and their risk-to-reward ratios and average returns, you can make informed decisions about where to put your money. As always, it's important to do your research and consult with a financial advisor before making any investment decisions. Thanks for watching, and don't forget to like and subscribe for more financial education. Leave your feedback on the comment section.